helpful. All right, guys. So welcome. I don't have like I would have done like a fancy PowerPoint. I'm really big on like the three different learning styles, right? Visual, auditory, and then what was the second one, CC? Tactile or something, tactile,
Yeah,
right?
tactile.
So I really like PowerPoints for that reason because I could keep talking at you guys, but then PowerPoints you could really visualize it and it's set in stone. So I threw some things here. So today we're really just going to go over basic product stuff that you should know when you're doing mortgage protection. Okay, so there's two different things. We have normal mortgage protection is what I call it. That's if someone can qualify for term, right, up to 500,000. You're typically younger and healthier. I say younger. I mean, it's kind of better to put it if you're younger, but some of the term products go to age 20 to 75, but you have to be incredibly healthy for term. Simply put, because if the insurance carrier is going to approve you for 500,000, they're not going to give someone who just had a heart attack a year ago 500,000 that if they died, it's going to go to their family. That's why, like, if you think about it, it wouldn't make any logical sense. That's why the underwriting has to be very, 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 very strict. That's for term. Just think about it. Large face amount, you got to be very healthy. They look at your background, your DUI, felony record. If you have asthma, some freaking companies decline you for asthma. Mutual of Omaha does. I only know this. I'm not a know-it-all. I just learned it by by experience. I'm like, what the heck? You guys can't take this guy for seasonal asthma. And so I had to pivot to a different company. So the purpose for these trainings is just to prevent you guys from losing a lot of time and a lot of money, but it also helps. I think failure is the best kind of not failure, but errors, learning by, trial and error. Okay. So a term is like normal mortgage protection. That's when you're going to sit with the client and say, hey, Betty, 100%, 75%, or 50%. That's for term. Younger, healthier, typically issue ages from 18 to 75. It depends. So, like Prosperity, for example, you could start as young as 18. Americo, you have to start as young as age 20, but it goes to 60, 75. So, you guys just, I need you to know you're typically younger and healthier, but it's your job to kind of dive into our different products to study. Okay, cool. Americo's age 20, Prosperity's age 18. Americo only goes up to 450,000, Prosperity goes to 500,000. But for example, Rihanna's in California, Prosperity is not accepted in California, which sucks. That sucks. But for her, she's probably using a lot of Americo. So again, term is like normal mortgage protection, 100%, 75%, and 50%. Equity protection is just a fancy word. I don't want you guys get confused, but we call it equity protection or payment protector. If you have access to the script, you could use one or the other when you're reading that paragraph that says if not healthy. Okay? Equity protection or payment protector, all that simply means is that we're using a whole life company to pay the monthly mortgage. We're not going to pay off the full mortgage because Betty's 89 and she can't qualify for term, or she's 75 and she can't qualify for term because she has COPD, right? So we can't go with the traditional 500, 300, 200,000. We have to pivot to whole life because whole life, they're more lenient with their underwriting. And simply put, because the face amount is only maxed at 30,000 sometimes, depending on the age. That's for whole life. Okay, whole life, remember, older and their health is not the best. Okay, that's equity protection, right? Because, for example, let's say Betty is 67 and she has COPD and like insulin diabetes. She can't qualify for term, 67, and her mortgage is 200,000. But her monthly payment is only 1,500. Therefore, I will show Betty 12 months of her mortgage payment to protect what she has in her equity from her house. Okay, it all kind of like pieced together, but all we're doing with whole life is we're saying, hey, Betty, right, due to your age and your health, what they're recommending is the best option for you is what we call equity protection. This is gonna allow you to set aside a certain amount of your monthly mortgage payments so your family's not rushing straight from the funeral home to the real estate office. It's going to give them enough time to grieve, get adjusted to not having your income, but also if they have to move your belongings out of the house, put the home on the market, that way, whatever equity you have accrued in your home and the biggest asset of your life, you can make sure that equity stays with your family and it doesn't go back to the bank. That's all it
You
means
said
when
it.
we say equity protection. Go ahead, Ryan.
You said it only goes up to like 30,000. Is that
Depending
true?
on the product. So some of them go up to 50,000 if you're like age 40. I think Aetna goes up to 50,000, but the older you get, the smaller amount they'll allow you to get. So for example, if you're 60 or 70, it might only go up to 30,000. And that's something that you could look on the quote tools, right? For example, you could find this out going backwards. I know you don't have writing numbers, but sometimes you can mess around in the quoting tool and put like someone who's 80, 85, see what their max is. It'll show you. 2,000 to 20,000 or 25,000. Okay. So that's again, just know that it's a lower face amount, sometimes up to 30,000, depending on their age, it might be 40 or 50,000. You'll see. But then your underwriting is less strict. So you could have COPD, you could have, a stent put in 4 years ago. Okay. You could be on blood thinners. Okay. Yeah.
Okay. And
I know you're
then
kind of tracking that. Mm-hmm.
so it like so let's say for instance it's a home is worth $300,000. The person has $100,000 of real true equity, and then the maximum we can do, if they'll allow, is $50,000 of a whole life.
Correct.
What kind of situation does that put them in then?
If they can't qualify for term.
But I
Okay.
mean, like it'll
Yeah.
protect them only for how
Right.
long then?
Good question. Okay. So let's say that person, that same scenario, they owe, you said 200,000 left on their mortgage.
Yes,
Okay.
because
So
they
let's
have
say they owe 200,000 and they can't qualify for a normal $200,000 term. So then we would look at, you said 40,000 whole life, like hypothetically speaking.
yeah, or
Okay.
50 if you
Right.
put 50.
So the key ingredient or the key thing to the equation is what are they paying a month on their mortgage? So give me a number. What is your monthly mortgage payment?
Say it's like 1,500.
1,500. Okay. So let's do 30,000, divide that by 1,500. 30,000 divided by 1,500. If everyone's writing this down so you could see it, that is going to pay 20 months of her mortgage.
It's almost 2 years.
Almost 2 years. Correct. Okay. That's a very good question. So now we're not going to say, hey, Betty, sorry, we can't cover the 200,000. I'm going to say, hey, look, because of your age and your health, you're on oxygen or not on oxygen, but you have COPD. Most insurance companies, Betty, they decline for COPD, but I did find one that they might look at accepting you. The great news is you have $100,000 of equity in your home. I want you to write down $100,000, Betty, so they could visualize it. That equity is going to keep growing every year you pay into that. Now, Betty, the moment you die, the mortgage company isn't going to demand for your family to pay the 200,000 left on the loan. All they care about is that someone is able to pay the $1,500 every single month. Because if you miss your mortgage payments, we don't want the home to be foreclosed and you're going to lose the 100,000 along with the home, right? And all the equity that you built into it. So what we're looking at for you is called equity protection, which means right now you could pay I'm going to show you three options, right? 20 months of your mortgage payments to be paid so your son doesn't have to pay for it, a year, 12 months, and then 9 months to pay your mortgage payments. Now, typically, we know the market isn't going to be like you can't sell a home like hotcakes. It's not happening. It's probably going to take, right? If you put it on the market, well, first off, you pass away. How long is your son going to need to move all your belongings out? How much time is he going to take off of work? Then he has to put it up for sale and then wait for the home to be sold. And that transaction could take 30 to 45 days. So all we need is time. Because I don't want, you don't want your son paying for those extra mortgage payments out of his own pocket. You want to make sure he's going to get enough time so then he could secure that $100,000 of equity or whatever you've accrued in it. And so that's basically the picture we're painting for Betty. You look
So as long
confused.
as we can cover them for 6 months or more, we should be okay.
Yeah, or even 3 months. They could probably get it done in 3 months if you want. All they're making sure is that their beneficiary isn't going to pay $1,500 out of their own pocket just to make sure the mortgage is afloat or that their payments are afloat. Does that make sense? Yeah. So that's all equity protection is. That was a great question, Ryan, because we actually painted a picture for everybody to kind of see what that looks like. We just use equity protection or like we just use whole life companies for equity protection. That's what we call it. Equity protection. That just means the person is too old or they have health conditions that don't or that disqualify them for term. Okay. So now I'm going to show you guys. So again, two differences, mortgage protection or equity protection, term, right? And lately we've been using IULs, Index Universal Life. the simplified issue IUL, I don't want to confuse you guys. Just think of the IUL as like a mix of whole life and term into one, meaning with term, you get a large face amount and you get living benefits, but it expires. You can't grow cash value with term. Whole life is permanent. It doesn't have that many living benefits, but it grows cash value. And index universal life is like a baby of that, right? Like they had a baby, right? So that just means index universal life, you could have a large face amount. It's designed to be permanent and it has cash value growing every single year.
Yeah, they're going to
I
get dividends or returns off that.
correct. Yep. And I love the IUL simplified issued version. Just simply put, like, so for example, the two IULs that I'm going to use for mortgage protection, the simple version is the Americo IUL, goes up to 450,000, is permanent and has living benefits. Okay. And then the the Mutual of Omaha IULE is the original. We had that, like they just made the Americo one in the beginning of this year. But the Mutual of Omaha IULE is what they call it, goes up to 300,000, I believe. But Americo just had theirs at 450,000. I've probably written, I don't know, 5 or 6 Americo IUL apps. That is like, if they could qualify for it and it's in their budget, I go for that. Okay, that's like I said, that's a mix. You could use that for like a normal mortgage protection if it fits within their budget. All right.
Is there a product that we have where they can actually utilize, like take out a HELOC, like a home equity line of credit, to then maybe put towards an IUL or something like that?
We don't have a product for that. That's a great question, but I'm not like a lender to help or a bank to help them like create a HELOC, but that's a very creative way to try and start an IUL. I mean, I tell people you can't buy insurance with your money, you got to buy it with your health. So, okay. Noah asked, great question. Noah, let me pull up the questions. Okay, Noah, you got to write short, concise questions for me, bud. So I'm gonna just
All
look
right.
at your last one. Whole life is living benefits and cash value, right? No, whole life, the only living benefits with whole life is a terminal illness rider.
Oh, yes, I wrote that
Okay.
down.
But the permanent, right? So like an IUL has all of the living benefits
Yeah.
and it's designed to be permanent and it's a higher face amount. Just think higher face amount has living benefits just for the easy thing to remember. Okay. Any other questions? I'm going to move on. And then you can write your other questions in there. Do the best you can do. Okay. Noah, did you have any other questions? I didn't read your paragraphs.
No, no,
Okay.
I just didn't want to interrupt, so I just typed
Thank
it
you.
in.
All right.
They
So
could,
I'm gonna, yeah.
oh, I was just gonna ask if they do have an IUL, they can borrow against that to maybe pay off some of their mortgage.
Yeah, certainly. All right, I'm gonna share my screen really quick. Can you guys see it? Give me a thumbs up, Bree. Can you see it? Oh wait, I see. Is this my? Hold on, this is my screen. Okay, can you see my screen now? Okay, so I couldn't find our other sheet. So I want you guys to see this. We have a ton of carriers, a ton. But for your business to be managed well, just stick with like 3 or 4. Okay, so I'm gonna give you the top 3 or 4 that I use for term. Or I'll just give you 3. Or I'm just gonna give you the I think I only use 4 main ones. Okay. Americo, Prosperity, AIG, and Mutual of Omaha. Those are like the top 4 that I use. And then of course Aetna is great for whole life because Aetna accepts people with COPD. And this is key. They do not have a height and weight chart, Aetna. So if you have someone who's on the heavier side, go with Aetna.
Hey,
Okay. Huh?
so you use those 4 just for mortgage protection?
I mean, just for in general, honestly.
Okay, well, I'm just making
Yeah.
sure because you started with term and then all of a sudden
I
you
know that's good. I mean, in general, so I'll show you the term ones that I really use for like Americo, for example. There's different products. So each company, guys, on this screen, we have access to all of these companies. They have term and they have permanent products. Permanent, when I say, hey, permanent coverage, it's whole life or index universal life. So we have term and we have permanent products. Each of these companies, except for I think Aetna and AIG, they have variations of term and permanent products for the most part. Okay.
And
So,
Americo, what were they again? Americo.
oh, America. So my go-to Americo and Prosperity. If you get someone who's completely sick, AIG, if they're like, they're on dialysis or they have cancer or something crazy or they have, yeah,
Oh, and
that's
Mutual of
AIG.
Omaha.
And Mutual of Omaha is a good one too. That's like my third try because Americo now, the reason why I use Mutual of Omaha a lot before Americo is for their IUL. Now Americo has it. I'm going Americo all day.
Oh, okay. I was just trying to, the four that you said, I was trying to put it in a text that the four that you said earlier
Oh
when you
yeah,
first got to it.
Americo, I think it was Americo, Prosperity, Mutual of Omaha, and AIG.
Perfect. Got it.
Yeah. And like we have access to all of those other ones. I mean, I've done a couple Ethos, I've done a couple. I mean, Aetna's great. I love Aetna. Aetna was because I did final expense my first 2 years, and Aetna was my number one carrier those 2 years, which is kind of crazy. I love Aetna. They're great. But now that I'm talking to mortgage protection clients, they're typically younger, younger and able to qualify for term. I barely wrote term my first 2 years because again, my demographic was focused on final expense. So now that we're talking about mortgage protection, you're going to be writing a lot more term, a lot more IUL. And for older people, seniors, we're doing equity protection with whole life. Okay. So
Okay.
the reason why we want to keep it minimal I don't want you writing random carriers because it's hard to keep track of like your debt that way. Right. So for example, if I write America and Prosperity top two, like all the time, and then I write a random Transamerica, if I got a
Okay.
chargeback from Transamerica, that's going to be harder for me to like recover on that debt. But if I write just America and Prosperity all day, every day, I get a few chargebacks from America. I'm not worried because I know I'm gonna replenish that chargeback. Versus now I'm gonna
Okay.
have to pay Transamerica like let's say I get a $500 chargeback. Now I'm gonna have to pay 500 out of my own pocket for that instead of just writing a policy. So it's just good to just stay within the like a few carriers. Now, of course, if you have someone who can't qualify for those four carriers, okay, yeah, branch out, figure out what it is you got to do, but don't get in the habit of just writing Aflac because you want to. Okay. Does that make sense, guys? Cool. I hope this is helpful. I can never, when I'm sharing my screen, the dang thing is always blocking. Hold on. And let me stop share really quick. This is annoying. Let me flip to this. Product cheat sheet. Okay. Couple things before I show you this quick little Google Doc that I have that Rihanna and I are going to continue to write in. You have access to the cheat sheets. Okay. If you go to the downloads on whether it's Inspire, I'll show you. Let me now share my screen again. I like to use FFL America. That's all I use, but we also have access to Inspire Group. So let me show you this, share my screen. Okay, this is how you guys are always going to find it. I would copy these and save it to your files. These two things I'm going to show you. Oh, darn it. How do I? Hold on a second. Clearly, I'm a little challenged. Hold on. You know when you share your screen, it blocks the bar from freaking touching your screen. Okay, anyways, here I am. Back to where I'm at. Okay, you're here at FFL America, or you could simply do Inspire Agents too. They have the same things there. You're going to go to products. If you haven't seen this video on your downtime, I wouldn't do it during your IPAs. Watch this video. And I guess, Ryan, you don't even have your writing numbers. I would watch this video. It's a product breakdown in depth. It's like an hour long. I would not do this if you're supposed to be dialing or making income producing activities, but do it on your downtime. Okay. If you go here, guys, everything's here from like the underwriting guide and like there's prescription guides. Some of these might be outdated, so you could actually find it on the carrier website. Just get familiar with this website, guys. There's everything you need on here. So instead of asking your manager, hey, where can I find like the underwriting guide for Prosperity? Just go find it on the website that you have access to. Okay. So here we are. Here are your cheat sheets. I would print this out. Some of these are outdated, so if you print it out, you could cross it out and put the correct numbers or the correct amounts. So have these out, right? Final expense cheat sheet and term cheat sheet. Now on here, let me open up the term one. If you go here, here's just some of our top term companies that we use. So familiarize yourself with that. On the left-hand side are the conditions. And then this is how you could, like I said, it's a cheat sheet. Scroll. Now, when you scroll down, it's going to show you some important information. Americo, HMS, they have a CBO, term 125, term 100. It shows you the ages. It shows you the height and weight. The height and weight's important. I used to be very negligent in the beginning. I mean, I was new and I would just like apply and I'm like, dang, I didn't even look at their height and weight and they got declined and now I'm having to backtrack. So again, height and weight build chart. Okay. This is also, like I said, outdated. So if you print the copy, you could write the IUL information on here. They don't have the IUL one. So just, you know, make shift with what you have. Scroll down. Here's Ethos's stuff. You could also go to each carrier website to download, like I said, their updated underwriting guide, 2 million max, their age 18, or I think it's right there. Prosperity, love Prosperity, ages 18 to 75, height and weights to the right, what they have, what the riders they have. That's all right here, guys, at your fingertips. Print this, save it. Also, I would physically print it, and then I would also download it to your files so you have access to it without the internet. Okay, all of that's right here. Now, that being said, oh my gosh, hold on, guys, hold on. There has to be a better way. There has to be a better way. I'm gonna do this so then that way when I open my sheet, hold up, and now let me share my screen. Oh,
You want me to share the screen, guys?
I'm gonna try it this way now, and then I will ask you. You always save me when I need you. Okay. Final expense cheat sheet, same thing, guys. All right here. It doesn't have all of our companies, but just know these are the main ones. Again, they're all right here. Like, do some light reading if you want, and like study this stuff. Right? We have the potential to make more than doctors, but we're not needing to study like for 8 years as long as doctors. But then people forget you have to be learning every single day. There's so much information. So just flip through this if you're bored. Don't just play a video game. Why don't you get good at your job, right? Because it's going to help you make a lot of money. So like I said, a lot of the stuff that might be outdated. So if you print it, change this to issue ages 40. I think they go to 40 to 80. And if you remember, we never use Eagle Guaranteed. We just use Eagle Premier. I'll go a little bit more into that as well too. Let me do this and flip.
Hey, we gotta hurry up so we get a shake.
Say that again, Ryan? Or Abel? Or who's talking? You have a question, Abel?
No, I don't. I'm sorry. I'm muted.
It's okay.
Actually.
No, it's okay. All right.
So with your the people who do not need the height and weight, whatever, that is the 4 carriers you just read off to us, right? Under that case, or did you mean because of IUL?
Oh, so you're asking what carrier does not ask for their height and weight?
Yeah, because
Aetna is the only carrier that does not ask for your height and weight, and that is a whole life company.
Okay.
Aetna does not ask for your height and weight. When we go to Aetna, I might as well. Oh my gosh, do I not have Aetna on here? Oh, we do. Aetna issue ages right here, ages 40 to 89. Aetna, okay, this is actually really important. Aetna is the only carrier that we have that goes all the way up to age 89. Most carriers stop at age 85. So if you have someone that's 88 or 87, Aetna is the way to go. And again, they do not ask for height and weight. I think their max, honestly, I think their max might even be 50,000 if like the person's 40. So you should double check. I mean, it goes, I want to say it goes up to 50,000. Okay. Now this is a whole life company and it only has whole life. So let me, I guess since we're here, we can talk about it. Aetna has 3 different tiers, different rate classes. Okay. So if you're going to write this down, they have preferred, standard, and modified. Now, off the top of my head, the only other companies that have 3 different tiers is Prosperity. Prosperity's whole life, they have something that's called level. That's like your a tall, right? If you're talking about Starbucks, right? There's basically, I want you guys to know, you know how like Starbucks has tall, grande, and then there's like venti. It's just a small, medium, large. People call it different things, so that's all I'm saying. So just know Aetna has 3 different classes, and then we have Prosperity, for example, who has 3 different classes. Aetna's preferred is the same thing as Prosperity's level. Now, Aetna's standard. So I want you guys to know preferred and standard, it's immediate coverage. Immediate simply means if the client gets approved and they make their first premium payment, and if they die in the next 5 months, they're going to get the full protection. Okay. If they're under modified or if you have a graded product because you're a higher risk class, which means that just means you're a little bit unhealthy, but they still accepted you. So they kicked you to the higher rating class. It's typically more expensive, but then all graded means is that if you die in the first 2 years, your family's not going to get the full death benefit. They're going to get a portion of it, depending on what company. Okay. That means, guess what, guys? If you had, what's a good example? Let's say you just qualified for graded, right? How I explain this to clients is to say, hey, I'm glad, like, great news. Now, most companies would decline you for your condition, whatever condition it was. But good news, this company's actually going to look at you. They just moved you to a graded class. All that means, Ryan, is that all that means, Ryan, is God forbid if you die in the first 2 years, your family is going to get 110% back of whatever you paid into it. Okay, so I'm not going to say, hey, Ryan, sorry, you're not going to get the death benefit in the first 2 years. I still make it like it's a great thing because they didn't get a flat decline. So that is something that I'm going to have you guys study and do your homework on. Understand the different rate classes. Okay, preferred, and look through each chart. What does that mean? Figure it out, because then when you do that homework, it's going to stay in your head.
Okay,
Okay,
Des.
different race classes. Yeah.
Sorry. So does that mean other than like for health reasons, like special job classes like flight status and stuff like that, would you also go through them only, Prosperity and Aetna?
For different health classes, what do you mean? Can you explain the question?
Sorry, one sec.
That's okay. Bless you.
Oh no, I feel like I'm choking. So if somebody would have declined somebody because of a certain like health reason, and these have like different rate classes,
Yeah.
I was just remembering in my studying that people with certain jobs, like people who like to fly or have certain activities, they would be under modified, wouldn't they? Because they have like a high risk.
Correct. So that's more of a question for term. I'm not 100% sure what the job class is if they would decline you. I know for sure, for example, I had a client that he's being deployed, and Mutual of Omaha will decline anyone who's going to be deployed going to a different country. But I know another company, if NLG, for example, so this is just an example. Each company is different. NLG said they would accept someone as long as they're not going into a war zone. So,
yeah,
and that's a question you could call the carrier and ask. I don't know that off the top of my head, but for this example, I don't believe Whole Life asks you if you're going to be like parachuting or skydive.
Flying a plane or anything like
Correct.
that.
And that's a question you could ask too. That's a good question. All right. So your homework, if you're writing anything down, figure out and understand what it means with preferred, standard, and modified, or what the other risk classes are for each company. So Aetna has different risk classes. Prosperity does. AIG SIWL does. It's 2 tiers. They have like preferred and graded. Some of them only have 2, and then some of them have 3. So Transamerica has 3, Aetna has 3, and then other companies, for example, Americo, they don't have risk classes. You're approved or declined. You're approved or declined with Americo. Okay, so just understand which those are so you're aware of it, and then you could dive deep into that. Okay, I am gonna move on to the main companies that I use for term. Okay. Remember I told you guys I love Americo and Prosperity. Those are like the top 2 companies that I use for term, like normal clients getting like they have like a $500,000 mortgage or $300,000 mortgage. Those are the top 2 I'm going with. So let's just talk about Americo really quick. Americo has like 4 different term products. I only use, or they have like 6. The main ones you're going to use are term 125 and term 100. Okay. They have something called CBO. I rarely use that because I normally put somebody into an IUL. But I'll explain to you what those are. First, let's just talk about your basic term 100. It's just as it sounds, right? It's just a term. And with term, depending on your age, I think it's like a 15-year, I don't even know off the top of my head, but when you go to the quoting tool, you can see the different term ranges, right? There's like 10, 15, 20, and 30. Now, if you're 65, they're not going to give you a 30-year term. So again, depending on your age, you'll see that restriction when you go to the quote tool. So if you're curious, just go to the quote tool and put a 60-year-old and see what that max is. But I don't know that off the top of my head, right? So again, term, different ranges for term, 10, 15, or 30-year. And like, don't quote me on the exact ones. You could go to the term thing and figure it out. It's a level term. They go up to 450,000. Now, term 100, guys, and term 125, they're the same exact thing. The only difference is that term 125 has 25% more accidental. That's it. So it's a little bit more expensive than, I mean, it's not even expensive. It's like a couple dollars more because the client's going to get more benefit if they died of an accident. So I'll give you an example. If someone got term 125 and they got $100,000 of coverage, if they died in a car accident, their family's going to get $125,000, 25% more for an accidental death. If they died of natural causes, their families only get $100,000. Term 100, if they die of natural or accident, their family's only going to get $100,000. That's it. So if I'm going to go term 125 all day, all day. Now, if their budget is super freaking low, then okay, maybe we could look at term 100. But I'm just, without even asking them, I'm not going to ask, hey, client, do you want term 125 or term 100? You as the professional, you're going to make that decision based on their budget. That's why in the financial inventory, it is key to ask, how much are you saving every month? Hey, Ryan, I know you're making $5,000 a month. Your mortgage is $2,000 after you pay all your bills, you know, utilities, groceries, car insurance, and then after all your fun hobbies, what are you saving every month? I'm not going to ask, hey, Ryan, are you saving anything any month? I'm assumptive. I'm like, hey, Ryan, how much are you saving a month? That's key. Not like, hey, are you able to save a little bit? Like, what do you typically see yourself saving? I'm like, hey, how much are you saving? Okay, that's how I ask that question. So again, Americo, term 100, term 125. Okay, and then they have another term. It's called, so they have two different CBO products. The other CBO one, it's not listed on here, but I don't want you guys to get confused. All CBO stands for is cash back option. So they get a term. It's the same thing as term 100 and term 125. The only difference is that if Noah qualified for a 30-year term and he didn't use any of the death benefit in that 30 years and he didn't use any of the living benefits and he paid for that entire term, Noah is then qualified to get his money back after all those 30 years. That's all it means, cash back option. Now, CBO is going to be way more expensive than a regular term. Why? Because the client's going to get their money back. The insurance company is not going to make any more money because they're going to be getting their money back if they live to that term. So for some people who are savers, you could tell them, hey, CBO 100, if it fits in their budget. I don't really use it as much, but I want you guys to know and not be overwhelmed when you see CBO, just cash back option. There's another one called CBO 50. Okay, it's 50% of your money back. So it is a little bit less expensive than CBO 100. Just you could, and if you're very curious, just mess around with the numbers and see what those price differences are. But it's pretty big. Term 100 is a lot more cheaper compared to CBO 100 for the same face amount, right? Because they're going to get their money back. That's all it is. So the main three products I use for normal mortgage protection, guys, is term 100, term 125, and then the IUL. Like we talked about before, Americo just created this IUL this year for us in 2024. What was it? February of 2024. And all it is, guys, remember, an IUL, for simplified issued IUL with Americo, it's permanent coverage. It goes up to $450,000 and it has all the living benefits, all of them. Okay. And it builds cash value. I will write IULs all day if the client's young enough and healthy enough to qualify and if it could fit in their budget. All right. That's Americo. Oh, and that's Americo's term product, guys. The only final expense product that we will ever use is Eagle Premier. It's a whole life product. It goes up to age 40 to 85. It builds cash value, but not as aggressively as an IUL, but it does build cash value. It goes up to 40,000 depending on their age, right? If they're older, they might only be subject to 30,000. And you can mess around with the quote tool to figure out, oh, at what age does that 40,000 go to 30,000? You can mess around. I don't know it off the top of my head, but just know that you have access to the quote tools, okay? Now, the thing with Americo that's key is that they offer a non-smoker rate for 3 years if you are a smoker. If someone's a smoker, their insurance rate is always going to be higher than a non-smoker, right? That makes obvious sense. But Americo offers a non-smoker rate for 3 years. So what you could do is you could position the client. Now, me personally, I don't like to put clients who are smokers into this position just because I don't really know if they're going to quit after 3 years, and I don't want to feel like I'm responsible because I have to remind them to go do the swab because they'll send a kit, you swab it, and you send it back to them to prove that they're a non-smoker. And guess what? If your client said that they were going to quit smoking, but they didn't after 3 years, their premium's going up or their coverage is going down. And that's something that I don't really want to have to remember. So I might just not even offer them a non-smoker rate if they're a smoker. Unless they're like, Desiree, I'm really going to quit. I'm for sure going to quit. But I normally don't like to do that. I just want you to know, it's going to be cheaper if the client is a smoker going with Americo. But again, I don't want to do that because I don't want to have to wait 3 years to remind them. But just so you know, okay? So again, Americo, the only final expense product is Eagle Premier, issue ages 40 to 85. And then again, term 100, term 125, and their IUL. That's all I use. Moving on to Prosperity. Now, I love Prosperity's Family Freedom Term. Okay, their Family Freedom Term, issue ages 18 to 75. It sucks because they're not accepted in California Family Freedom Term. I think they're accepted for their final expense. I think Ree will tell me that too. Now, Family Freedom Term, guys, is cheaper than Americo. It's cheaper than Americo if we're looking dollar to dollar. If I'm looking at a $300,000 30-year term for a 50-year-old or a 40-year-old and a $300,000 30-year term for a 50-year-old for each company, Prosperity is cheaper than Americo. Reason being is that their living benefits are less than Americo's. But I don't tell the client that. So if I just look at how much the client's saving, and if they're like barely saving, like, and we can't really go to an Americo policy, I'm going to go Family Freedom Term all day because it's the cheapest term that still includes living benefits. And you don't have to tell that to the client. Just be like, hey, you have access to critical, chronic, and terminal illness, and this is the best option for you.
So
Okay?
what do you mean? What do you mean less than Americo?
So Americo's critical, chronic, and terminal illness, I don't know this off the top of my head. If you want to call the company, you can. I think their living benefits is like 80%. I think you have access to 80% of the death benefit. Prosperity is like a smaller amount. I think it's like 50 or 30. I don't know.
Okay.
Yeah. So
Okay.
cheaper is not always better, guys. But just know at least Prosperity, it's not a basic term with like, I don't think you're serving the client if you put them in a very cheap term that doesn't have any living benefits. But at least they have living benefits with Prosperity. Family Freedom Term. Okay. Okay, so that's Family Freedom Term. The only companies you're going to use or the products you're going to use for Prosperity for term, they're very simple. They only have one term. It's just Family Freedom Term versus like Americo's 7 terms that they have. But Prosperity, Family Freedom Term. Oh, accept count. Thank you, Rihanna. And then final expense, guys, their product, it starts at age 55, which kind of sucks because Americo's product starts at age 40. So there you go. And it's a whole life company, builds cash value. Remember, guys, whole life does not have all living benefits, just terminal illness. Terminal illness. What's amazing about Prosperity, too, is that they do take cards. They take Direct Express cards. If you don't know what that is, that's like if a client's on Social Security, they don't have a bank, and they take like debit cards. Now, I don't want to tell you guys to just, if the client says, oh, I only have it as a card, like, I want you to find that routing and checking number because guess what? If the client's card is expired and they forget to put their routing and checking number in, now they lapse their policy and now they die and now they don't have coverage. That's why most carriers want routing and checking numbers. But if they really can't find it, just put the card information for there and then just make sure you as the financial, like, and being a fiduciary for your client, make sure you get their updated routing and checking number and make sure that they're able to keep paying on their policy. Because if they don't have coverage, they're not protected. And if they die, like just make sure they have it. Okay. So Family Freedom Term, their whole life is right here, ages 55 to 80. Oh, I do want to touch on something really quick. I forgot this. Most companies, guys, they only take routing and checking numbers. Okay. All carriers require routing and account numbers except for Prosperity. You have the option to do routing and a card. AIG and Transamerica, and I guess Ethos is what Rihanna added on here. But remember, we don't want to push for just being okay with a card. We want the client to be in the best position possible to get that routing and that checking number. But worst case scenario, because when you're working with final expense clients, you will come across people who are only on Direct Express because they're on a fixed income. Then, okay, cool. Go Prosperity, go AIG, go Transamerica if you need to, and so on and so forth. Most whole life except people 40 and older, excluding Ethos. Oh, this is another tip. Okay, write this down. We know whole life companies only take people as young as 40 for most of our companies, like Americo and Prosperity. They don't take anyone. Well, we just said Prosperity is 55 and older. Americo's 40 and older. Aetna is 40 and older. So what happens if you come across a young client who can't qualify for term, but they could qualify for whole life? Ethos starts at age 20, I believe, their final expense, and Transamerica starts at age 18, and it goes up to 50,000. If you come across a client who's young and they could only qualify for whole life, these are the two companies that you could look at options for them. You wouldn't be able to look at Eagle Premier because guess what? They're 25, they're age 25, but Eagle only looks at people who are 40 and older. That's key. Just know, cool, I got a young person who's not the healthiest, but they could qualify for final expense. We're going Ethos or Transamerica all day. Okay? Next, so yeah, those two things, routing account numbers and then like ages with final expense. Going to Prosperity. Prosperity is simple. There's only two products there. AIG. Okay. AIG guaranteed issue. So let's just say you come across a client who is deathly sick. I don't even know if I would say deathly, but they're on dialysis. They have a condition that would decline across the board with our major final expense carriers. Like they have an oxygen tank. Oxygen tank is typically a decline across the board. This is just an example. If they're in between the ages of 50 to 80, we can still cover them, guys. We can still cover them. This is great. I love AIG. GIWL is what we call it. Their guaranteed issue, right? Let's put GIWL. GIWL. And then their simplified issue, that's their normal whole life, like Americo Eagle is SIWL. Okay, but GIWL is when you have someone super, super sick that they get declined across the board with everything else. AIG does not ask any medical questions, and they'll accept anyone ages 50 to 80. Now, with that being said, guys, they're not going to get immediate coverage. They have that 2-year wait period. Okay. Now, this is how I say it to clients because I don't want them to be bummed and not go forward with the coverage. Now, let's say I have someone who's super sick. I always make everything a big deal. If they're taking freaking a small medication for cholesterol, I'm like, man, well, so since you're taking atorvastatin, Betty, I'm going to do my best to try and find you the best option. But remember, these insurance carriers, they're super picky with who they select. I normally make everything a big deal. Now, let's say someone does have a really big deal and they had like a heart attack 2 months ago and they just got out of the hospital. Every single carrier is going to decline them except AIG, GIWL. So then I'll say, hey, John, so I just want you to know, I'll explain all the benefits, like whatever part in the script, I explain the benefits and I'll say, hey, so good news is this company might look at accepting you. The only thing is I want you to know that the first 2 years of this policy, it kind of just acts like it's like an investment in the first 2 years. That being said, is they're not going to flat out decline you, but God forbid if you died in the first 2 years, your family is going to get 110% back of whatever you paid into it. So just think of that period as like an investment part. It's going to act like an investment account. That's what I say. It's going to act like an investment account. You're going to get 110% back if something happened to you within the first 2 years. That's still 10% more. So I'm not going to be like, oh, sorry, you're not going to get the full death benefit. We never want to paint the picture that way. I say, hey, the first 2 years it's going to be like an investment account. Your family is going to get 110% back of whatever you paid into it. That's key. Practice that. Say it in the mirror, but that's going to help you a lot.
And
Okay.
then
Yeah.
just for your that deal that you said on Ethos and Transamerica for younger clients is on. We're doing the whole life or term, was it? Which
That was
one?
whole life.
Whole life. Okay, that's right.
Because
Whole
if they're
life.
young, Ryan, if they're young and healthy, we're going to go to an IUL. But if they're young and not healthy, we need to make sure we find that whole life company that would accept them because of their age, which would be Ethos and Transamerica.
That's what I got. If they're not healthy.
That's if they're not healthy. And how you're like, hey, Desiree, what does not healthy mean? Well, now you have access to the grid sheets to see. Yeah, because it's very subjective, I guess. But you could see the grid sheets to find out what do the insurance carriers classify as healthy or not healthy, which means what company won't decline them.
Okay.
Okay. Okay.
I've just been sending all these to like emails to myself. And you said this whole thing's recorded, obviously. Where is this going to be ported to after it's done recording? Where do we find this?
I think Diego might put it on like YouTube. I'll double check. But if you see us on Zoom, we'll let you know. It might take a minute, but yeah. Okay.
Okay, copy that.
Awesome. Okay, so guaranteed issue. Remember, if someone's super sick, we're going GIWL all day. but they have to be between 50 to 80. If someone has dementia and they're 81, they won't qualify for this because dementia is a declinable condition across the board. But if someone has dementia and they're 75, boom, get them coverage. Okay. Now, SIWL, I do like AIG's SIWL. Issue age is 50 to 80. I want to say it is. Sometimes things change. It might be 40 now, but I want to say it's 50 to 80. You could double check. It's just a normal whole life company with immediate coverage. They do have two different sizes. We could call it sizes or tiers. They have level and I think they have graded. I want to say level and graded. So that just means if you don't qualify for level, you might get kicked to graded, and a graded again is like that 2-year wait period with 110% back. And it's just a normal whole life. I think it goes up to 35, might go up to 50. It's a pretty good product. The reason why I like, and I could tell you with final expense guys too, there are some companies or even with term, I love Americo because Americo in the middle of the app will tell you if your client is declined before you finish the app. That will save you a ton of time. America will say, withdraw the app, the client can't qualify or whatever in the middle. And you're like, dang, it saves you time, you pivot. Now, like Aetna's not bad, but you won't know if the client is declined or approved till you finish the complete app. And then now you're having to pivot afterwards. But Aetna does have an auto underwriting system that you have access to at the end of the application when you submit it. Okay. Now, companies like Americo, right? They tell you if they're approved or declined. Prosperity does the same thing in the middle of the app. It'll tell you if the client gets kicked to graded or if they're declined.
Hey, Des.
Yeah.
So when would you use SIWL over everything else? Like why would you use AIG's SIWL versus anybody else's whole life? Because I understand GIWL and why someone would want that, but
that's a great question. So I would say for me, AIG SIWL's product in the middle, it'll also tell you if they're declined, and sometimes it'll tell you what medication pops up as a decline. They have a really good incentive program, guys, that if you write, I don't know if it's expired already, but let's say they said if you write 5 apps with them, 5 applications with them, they'll give you like a $500 bonus. So then instead of writing Americo Eagle, you could start writing SIWL just to get that extra bonus. But to be honest,
but to differentiate the two, there's not like a big difference between Americo's Eagle Premier and AIG's SIWL.
Yeah, AIG SIWL is going to be cheaper.
Okay, that was the thing I was missing.
For the most part, it's going to be cheaper. And Noah, you could double check some things, and their underwriting is a little bit more lenient, I think. So you should go download the SIWL underwriting guide, which go to AIG and just navigate how to find the underwriting guides. And I would download all of those guys. And I wouldn't say like memorize it, but at least you have it, and you could in the middle of like an appointment, you could Google, because AIG SIWL is pretty lenient with like cancers. Like if you had a skin cancer and it was like 3 years ago, or not skin cancer, just double check. But I just know they're a little bit more lenient with certain cancers.
Okay. Yeah, I was just trying to find
the big differentiator.
What differentiated them on why I would choose them over somebody else. Okay.
And quick tip too, Americo Eagle, they have accidental built into it, which means for the most part, their premiums are a little bit more expensive than, like, for example, SIWL and Prosperity. Americo Eagle's typically a little bit more expensive because they have that double death benefit, double accidental built into it. So you'll see as you go.
Okay, I didn't know that, so I need to write that down.
Yeah, so write that down. Americo Eagle, because if you look, and you guys, I would advise you to just like go to quoting tools and just mess around and see, okay, cool, Prosperity, I have the option to add accidental, or I don't have to, and that could save the client some money. So if you're talking to somebody who's on a really tight budget, you wouldn't want to go to Americo Eagle. You could probably go to SIWL or Prosperity because you have the option to add accidental or remove accidental, which is like an extra $1, $2, or $5. And that could save them some money a month. Okay. So, okay. I went over, okay, I think that's pretty much it. SIWL is just a normal whole life, but guaranteed issue is like our number one for people who are sick. Aetna, I told you already in the beginning, they're known for their no height and weight, and they go up to age 89. Mutual of Omaha, they're great. I mean, I really like Mutual of Omaha. They've been around. Most clients know Mutual of Omaha because they've been around for ages. Their normal whole life is called Living Promise. It goes up to, starts from 45, goes up to 85. It's like a normal, like I said, normal whole life is Living Promise. They have a product that's their term product is called Term Life Express, which is just like a Term 100. And you do have the option to add accidental, I think, in there. I think it only goes up to 300,000, guys. So there you have it. Why would I go to Prosperity instead of Mutual of Omaha? Well, if I have a client that has like a $350,000 mortgage. Okay. Now there's something called Term Life Answers. I don't want you to get confused, but this is their fully underwritten product that requires a nurse to go out there and do blood and urine. We don't write that. I mean, I personally don't write that. We're simply, I should just even remove this off here, but I just want you guys to see that it's on here and you have access to it. Okay, that's Mutual of Omaha. Oh, Ree, if you want, let's add a note. I want to add the IULE product here. IULE is just like the IUL for Americo. Just know that they do have an IUL product. Let's remove this as you guys are looking. And Rihanna will update that for us later, or I will just remind me. Okay, that's Mutual of Omaha. Ethos. Okay, Ethos has term products. This is very important. It goes up to 2 million. Right? None of our other term products go up to 2 million without requiring like a fully medical nurse, you know, blood and urine. But Ethos does for certain ages. 20 to 65 goes up to 2 million. I honestly think by age 50, you're only subject to 1 million. But like I said, each age is different when you get older. You're not going to get the same amount. And with that being said, Ethos's term does not have living benefits. Again, Ethos's term does not have living benefits. So I normally don't put clients in this position unless they're adamant about trying to get a large face amount. And I'm just going to be like, John, this doesn't have living benefits. I mean, I won't say it like that, but I'm just saying, cool. You're just concerned that if you die, the debt, the mortgage is paid off, right? And I never touch on living benefits when we talk about Ethos's term, but just know it can go up to 2 million non-med, and they're pretty reasonable price too. Okay, so that's Ethos's term, and then their whole life starts from ages 20 to 85. They have two different whole life products. There's an Ethos final expense. I typically just do True Stage final expense. Honestly, I don't know why. I just have only written True Stage, so that's what I do. I don't know the differences between the two, so you could, you know, double check there. They do take Finda's app on their end. Oh yeah, so Ethos is one of those carriers that you could send a link to them, to your client, and they could do the app from their end. Or you as the agent could do it. Now, I would double check because I think their True Stage, the client has to do it from their end. But again, just know Ethos, you don't have an agent number. You just sign into their, just search agents.ethos and then see if you have an account and put your phone number. And if you do and it works, you'll get a code and then you can log in and look at all their underwriting stuff and look at the different products. Okay, these are just the basic stuff. I just want to give you a basic cheat sheet. Okay. Transamerica could go up to ages 0 to 85, I guess. Whole life. This is their whole life. Builds cash value, takes direct express card. They have a term, but it's a fully underwritten. I never use it. So all you need to know for Transamerica is their whole life product. Okay, immediate solution is just as it sounds. It's immediate coverage. They have another product that's still whole life. That's called Easy Solutions. Is their graded product. That's if the client can't qualify, remember, for immediate. And it only goes up to 25,000. That's it. Okay. MM, I don't know. I rarely use MM. Diego really likes it.
Wait, sorry, can you go back real quick?
Yeah. Sorry, this should be like this format, but let me just do this. We'll fix it later. I mean,
Okay,
you guys will
I
get
got
the link for the updated version.
Thank you.
Yeah. And then MM, they have a term. Oh, sorry. Go ahead, Ryan.
On the one that excuse me, that doesn't offer that living benefit with the 2 million, could you put that like in parentheses or something, just that it doesn't offer the living benefit?
Oh, yeah. Thank you. And we'll make it all pretty and stuff. Okay. Builds cash value, takes direct express card, Transamerica, MM. I don't really write too much of MM. Like Diego probably knows more about MM than I do. Because like I said, I like to just keep all my carriers in one bucket. But just know that they have a term and they have another term. I don't even know what this is. A level term, ROP. Oh, you could get your return on premium. So it's the same thing as the CBO and then home protector, but they only go up to 300,000. So you might as well just go with another company that has a higher amount. And then the thing is with this term, I don't write it, but I know with the term, you have to add in the living benefits. So it's not like it doesn't have it, but you have to add it in so it changes the premium amount. I think that's why I stay away from it because I'm like, I just rather have something that it's built into it so I don't have to customize. Versus like AMAM, you could write the term without living benefits or only a portion. And for me, that was confusing. So I just I don't do it. That's me, but you could ask your manager. Oh, that's it. Perfect. Now that was kind of all of everything. You guys will have access to this cheat sheet. We'll probably share it as we go.
Okay, now recap.
Say that again?
I said, okay, now recap.
Oh yeah, recap. No. Any other questions, guys?
Are you gonna put this into the either the Google Drive or the Discord? So I can
Yeah,
just
Ree will add it to the Google Drive. She probably
It's
already did it.
already in there.
He's
Oh, okay.
on it.
Look at
He's
you.
the
Yeah.
best.
Rihanna. Okay, thank
And
you.
yeah, and then Diego, if you see on here, Ryan, you can subscribe to our YouTube page. We have a bunch of trainings on there. This will be uploaded whenever it's done recording.
Okay.
And yeah, guys, don't forget your homework. Your homework is figure out what level graded or modified for each company is. Like you go figure that on your own and then talk to your manager because you discovering it on your own will help you remember. And there was something else. Wasn't there something else? I think that was it. Just that's your homework. And then you have access to Americo, go mess around with the demo, e-app, and also just write different quotes so you're familiar with the quoting process. And then, oh yeah, go print the cheat sheets. I would get a physical copy and then you could edit it from whatever you find out. And then you could save those files also to your file. So like, for example, on my iPad, I have a file called underwriting and I have all of the prescription underwriting stuff, each company, SIWL. That's just a quick tip because I'll go on my iPad and I'll like control find and be like, they said they had heart failure or not heart failure, like congestive heart failure or whatever it is. It just helps you be more organized in the middle because your underwriting when you put the client on hold should be fast. You should test yourself to see how fast you can do it. We should honestly have a contest. That's a good idea. Let's have a tournament. Who could do the fastest underwriting? And when you have a client on hold and see what you're going to present. Okay, perfect. Well, if you guys don't have any questions, that's it. And let me stop recording.